In this video, I'll explain why there will be a stock market crash soon, which will lead to a financial crisis, and what my plans are. You might have heard a few people say, don't fight the Fed. It's because there's a relation between stock market and money printing. Here's the chart between the two. The blue one is the stock market graph, and the gold one is the money printing. You'll see there's a correlation between the two sets. The Fed prints money, the stock market performs, and when the Fed takes money, it does the opposite. That's why they say don't fight the Fed. Just look at 2020, how the stock market performed. S&P went up more than 15%. It skyrocketed. It's because the Fed printed record amounts of money. That's called quantitative easing. When the Fed removes money from the economy, it's called quantitative tightening. They printed way too much money back in 2020, hence the stock was able to rally in 2020. They had to print back then because we had lockdowns. We had unemployment skyrocketing and the GDP fell by 3.5%. When you print trillions of dollars and inject new money into the economy, that new money is going to inflate everything, including the stock market. Because of the money printing, we're facing high inflation. To lower inflation, what the Federal Reserve is trying to do is remove the money from the economy. Once the Federal Reserve starts to take the money back, then the stock market will go down. On May 4th, the Fed announced their plan for the quantitative tightening. The Fed said they're going to do the tightening by $47.5 billion a month, starting from June till August. However, they'll only remove $47 billion for those 3 months combined. They didn't do as they said they would. During the recent FOMC meeting, Fed Chairman Jerome Powell said the quantitative tightening will ramp up and will remove $95 billion per month starting from September. Let's see what the Fed's been doing. From September, let's see how much money the Fed has removed. Data is released on a weekly basis, and I'm going to show you what the Fed did till October 5th. During week 1, they took $4.2 billion. Week 2, they printed $5.5 billion. They were supposed to take money out from the economy, but they printed more money. Week 3, they've taken $16 billion. Week 4, the Fed removed $18 billion. Week 5, they removed $37 billion. So the Fed's ramping up the quantitative tightening. Starting from September, the Fed has removed a total of $69.7 billion for 5 weeks. Why do you think the NASDAQ dropped 3% in one day on Friday last week? It's because the Fed's doing the tightening and they're ramping up. Yes, the job market was released, but that's not the only reason. That's what the mainstream media will report. They'll not tell you this information. So the Fed has not been removing money as they said they will. They said they'll remove $95 billion a month starting from September, but they've removed $69.7 billion for 5 weeks. Yes, they're ramping up, but not at the levels they mentioned. It's because we have the midterm election of November 8th. They don't want a huge crash before the midterm elections, which might impact the current administration chances of winning again. Expect more quantitative tightening after the midterm elections. All this information is publicly available in the Federal Reserve website, and please take advantage of this information and act accordingly. Along with this, as I mentioned in one of the previous videos, following the monthly CPI data as well, because the Fed will tighten based on the monthly CPI reports, as Jerome Powell said his target inflation rate is 2%. The CPI report for the month of August is 8.3%, which is very far from the 2% target rate. Now, I'll show you something what Fed Chairman Jerome Powell said during a meeting. He says the quantitative tightening is off to a slow start, but it'll pick up pace starting from the month of September and will continue so till 2 to 2.5 years. This matches the data I just showed you.
I wanted to ask about the balance sheet reduction program. It's been working for a couple months now and in a different environment than the last time the Fed did it. What are you learning about how it's working and how markets are reacting? And is reaching the minimum level of reserves needed in the system still several years away at the current pace?
So we think it's working fine. As you know, we tapered up into it, and in September we'll go to a full strength, and the markets seem to have accepted it. By all assessments, the markets should be able to absorb this, and we expect that'll be the case. So I would say the plan is broadly on track. It's a little bit slow to get going because some of these trades don't settle until for a bit of time, but it'll be picking up steam. And I guess your second question was getting the process of getting back down to the new equilibrium will take a while, and that time it's hard to be precise, but the model would suggest that it could be between 2.5 years, that kind of thing. And this is a much faster pace than the last time. Balance sheet's much bigger than it was, but we looked at this carefully and we thought that this was a sensible pace, and we have no reason to think it's not.
So I just showed you this to understand how the Fed's quantitative tightening will impact the stock market. You already saw how the stock market is performed starting from September. Expect more pain. But here's the thing. It's highly unlikely the Fed will perform the quantitative tightening for 2 years. It's because it'll collapse the economy, so the Fed will pivot, and this will skyrocket the stock market again. However, the trade-off's going to be more inflation. The inflation's going to be worse than the current levels, and there's going to be a widening wealth gap. The rich get richer, the poor get poorer, and the middle class shrinks even more. I'll make a detailed video on Fed pivot soon, so please subscribe and don't miss that video. Also, the Fed's been rising interest rates, so expect more pain. So here's what I'm going to do. I'm not a trader, and I'm an investor. I invest for long term. I buy and hold. If you're a trader, this might not be applicable to you. I cannot time the market. Nobody can. So this is what I'm going to do. I'm not going to sell. I will not panic. And when there's a crash, I'll take a hit and try and buy more. I'm going to be patient and add more during the upcoming crash. It's because, like I said, I cannot time the market. You only lose money when you sell, and I'm not planning to sell. If you look at the historic data, you'll understand the pain will end eventually and the market will start the rally again. I can see what's coming, and I welcome the crash. It's not in our control, but we can take advantage of the current market. I'll add more after the midterm elections, and that's when the real crash will begin. And whenever I see red days, I'll add more slowly. I'll not go all in, but I will add little by little. If the market doesn't crash, which is very unlikely, then the stocks I hold will perform better. This is possible if Jerome Powell comes out and says he'll turn on the money printers. One final bit of thing I'm doing is waiting patiently. I'll not sell everything now and get back in when the stocks are cheap. I'll not do anything dramatic like that because that's a gamble, and I'm not a gambler. I'm an investor. Also, I will not advise doing so. But if you want to do so, please do your own research. People have different investing styles and strategies, and I just told you what I'm doing, but you can do as you prefer. Please subscribe. Thanks for watching. Until next time.